John Pugliano, happy to be back. Always good to be in Tennessee. Appreciate you guys coming out this afternoon. We've had a full day.
Wait, I thought Joe was giving this presentation.
We're getting to that. So you know what? I like to come up with fun titles, and I don't know. I thought Grifter's Guide was pretty interesting title for this. It's really all about Wall Street Jiu-Jitsu. I know a lot of people in our community, they shy away from the stock market or this system, and they think it's rigged, or they think it's the man's going to make all the money. Hey, I don't hate money. I'm going to go after the system and use jiu-jitsu to make it work for me. When I was doing this, by the way, my son Joe, you guys have a comment on him. Joe's joining me somewhat on this presentation. He's my tech analyst now. He's been with the firm for about 3 years. He's full-time now. When I mentioned jiu-jitsu, he just kind of laughed and he said, "That's the only jiu-jitsu I've ever seen you do." So Joe is going to help me stay on track. He's a man of few words. And those of you that met him, he's doesn't digress as much as I do, so he's going to keep me on time. And Joe, do you have anything to say?
Nope.
He was supposed to say next slide, but he missed his first key. We'll see how we do here. So what I want to talk to you today about, again, just breaking it down, everybody's on a different level, right? Everybody's on a different level of their preparedness, their wealth journey. So I'm going to talk broadly. I've been investing for over 40 years. I consider myself a prepper, I'm not a homesteader. I'm more of a suburban type prepper. Was raised that way, had grandparents that I saw live that way, and that integrated throughout my life as well as into my investing. And so I just look at it holistically, but I also look at it very cynically. And so we're going to talk about that. Really want to cover today really about what you're being sold from Wall Street, what you should be buying, and then we're going to have a little practice session. Maybe Joe will help out with that if we can get him to say anything. And then I'll give you my cynical view. So as far as Wall Street, people think you're going to a financial advisor or whatever you're going to, and you're being sold products, right? That's what Wall Street does. They sell products. It's all about marketing. They talk about it being an investment style, right? So there's different types of styles. Are you a value investor? Are you a dividend investor? Are you a momentum? Are you growth? And then all these words are then encapsulated into the regulations. I've been talking to some of you guys about the Department of Making You Sad and some of my recent experiences. But they use these words, are you a value investor? Are you this? It's all marketing, and what we're in this for is to make money, right? It doesn't matter what style, what method you use, going forward, making money. And so in this presentation, I just want to cover some of these things about, ignore the products they're trying to sell us, and let's talk about how we can actually make money. And I'm talking about the stock market because that's what I do, but I think you can apply this to real estate, crypto, right? Selling chicken eggs. It's the same concept. So you want to avoid products and you want to observe conditions. Again, they try and make it all fancy and all complicated. And the bottom line is, I just think there's really a couple conditions that the market's in. And if you learn to observe that, you can figure it out yourself. And it's like going outside. Is it raining? Okay, I need an umbrella. All right, it's sunny. Okay, I'm going to wear a short sleeve shirt today, right? It's sunny, I'm going to go to the beach. If you see the conditions outside, what, dressing or what kind of activities you can do. I think it's the same thing with the stock market. If you observe some conditions, you can make some rational choices as to whether you should be in these different styles of investing. Conditions. I think there's really only three, okay? And again, it's very simple, and we could make it more complex if we had to, but there's really only, I think, three conditions. Complacency. Okay, so complacency, fear, and greed. Complacency, this is all about passive investing. Dollar cost averaging, taking a portion of your weekly or monthly paycheck and in your 401k and just throwing it in the S&P 500. That's what I would say. If you live in San Diego, what kind of weather do you have? It's sunny, right? Complacency is kind of the way the market is generally, right? You look out there any given day in the stock market, it's pretty much complacency. People just investing. The other thing is fear. Fear is like, when a hurricane warning comes through. everybody panics. There's hysterical selling, and we'll see a little bit of that in the charts. But I think and the emphasis is always on the panic selling, but I think what's worse there is the panic buying, because that's when the people selling products are coming out of the woodworks telling you, buy, whatever they think is safe, buy. And you always think when people are telling you to buy, it's like, if it's so valuable, why are you selling it? So it's just something, not always, but think about it. Greed, Joey knows about greed. I highlighted the F. Let's see if we can get a practice session in here.
Starts with the same word as the last one.
Yeah. So greed is FOMO, fear of missing out. So even when there's greed, they want to emphasize fear. It's the fear. You got to get in. Got to get in now. It's going higher. If you don't buy right now, it could go to the moon tomorrow. It's fear of missing out. And the reason fear works so well, and reason greed has a fear component to it is because as human nature, as humans and human nature, that's our trigger. We're genetically predisposed to react to fear, right? If the big saber-tooth tiger is coming after us or something, and we don't get out of the way, we get eaten, right? So it's built into our DNA that we should be fearful when cautious. People selling products know that, and so they try and use it in their marketing. So 3 simple conditions. I would say, bottom line, for the most part, like you walk outside, if you walk outside here in Tennessee and it's like stormy and snowy and all this kind of stuff, like you see in this picture, and you figure, I got to go to work today, maybe it makes more sense just to call in sick and not go to work that day, right? Yeah, maybe you'll lose a day of pay or whatever, but what if you get in an accident? What if you wreck on the way to work? You're still going to miss a day's work, and now you're going to have a wrecked car. Maybe you're going to hurt yourself. You just stay off the roads that day. And that's a lot of things I think we can do with the market. Look out there. If it's complacent, hey, okay, things are pretty good. I'm going to stay in, or I'm not going to worry about it. But when there's all this fear and greed, maybe you just step back. So it is all about emotions, and we're talking about conditions, but these conditions are really just emotions. It's human emotions. And what I've learned, and again, I've been doing this since like 1985, what I've learned about human emotions is the more that we automate it, the more it's human emotions, right? The more you have high frequency traders, the more you have algorithms, the more you have all these things, it still comes back to emotions, and the emotions just get magnified by the trading. And a lot of times I look at it from my cynical nature that it's like being a magician. We talk about that a lot in our community, but when they're doing something up here with the right hand, you need to be looking at the left, right? Again, so when they're telling you to buy this, maybe you should be selling that, right? Or whatever. Those are the things I want to talk to you a little bit about today. But the thing about emotion with the market is, and I put up a chart of Dogecoin, you may or may not be able to see it in the back. It's just the scale of it isn't important. I just wanted to point that Dogecoin thing out to you. If you know anything about Dogecoin, it's, you can like crypto, you can be a Bitcoin maximalist, whatever. I think we can all agree Dogecoin is shit, right? I mean, it's really garbage. But it can fluctuate. It can be 50 cents, it can be $50. And there's no really rational reason why. It's all pure emotion. Somebody comes out and pumps it up, Roaring Kitty or somebody puts out a post, a bunch of people pump it up, they get everybody to buy it, they sell and exit, right? And then everybody else figures it out, they get out of it, and then there's some other event that makes it go up again. It's pure emotion, and I think really a pure con game. The whole market works that way to some degree, right? People are always trying to con you out of your money. It's the way it is. Emotions, though, the great part about them is, like I said, most time the market, though, it's in that complacency condition, just like San Diego's pretty much sunny. And these emotions are short-lived, especially on the upside ones, right? They go up real quick and they come down. Susan was asking me about if I'm investing in what's the mushrooms? Help me, guys. No, mushroom psychedelics and stuff, right? Psychedelics are real hot right now. Listen, they can go up really high, but they also crash very quickly. I don't know how to get out of that. I mean, I just avoid that stuff. I'm looking for things that are relatively stable, okay? Relatively. So I think the most important thing is to watch for the shift. We'll talk a little bit about that because, again, with this extreme example with Dogecoin, you can see it shifts, right? It'll go parallel for a while, stable, and then all of a sudden it'll shoot up. Once it shoots up, then it'll shoot right back down. So watch for those shifts and know that it's all about exhaustion. Again, when the magician's over here telling you to buy, why does it peak out at the very top and get exhausted? Because there's no one left to buy, right? There's no bigger fool to buy. And likewise, when it falls apart and it comes down, it reaches a low point because there's no one left to sell. Everybody that's sold has sold. The other people are hodlers. They're just staying in. They're not getting out. And so it's always going to fluctuate between those two extremes. Joe pointed this one out to me this week. Avis, and this is just a real world example, not something like a Dogecoin, but Avis stock this week, it had been very stable, right? Kind of just boring, dull. No one would want to buy it. And you can see down here the volume down below, it just was pretty much flat. And then all of a sudden, a couple weeks ago, it started going up in price. We start getting into that greed cycle, right? It starts moving up, and then boom, we get all super mega greed kicks in, and the short sellers come in with the squeeze, and the thing just falls apart. It goes up really quick on the squeeze, and then it just as quickly falls apart. This is just a couple days ago. And you can see literally this is all volume, and I believe this is not proportional. So these amounts are even higher than the smaller amounts over there, but no one was interested in it over here when it was only selling for like $100. But as it gets up to $500, everybody jumps in and wants to buy it. And it's just that condition of it's really frothy. I personally try and stay out of these situations.
Any clue what happened there?
The panic was gas prices are high, no one's flying, so that means no one's going to rent cars. So you had it going up, and then all of a sudden there's a panic. It's not, and so the short sellers short it. When in fact they end up not shorting it, the stock goes up and bounces high. And then, of course, there's no one left to buy, and it comes back down. It's like a pendulum that moves back and forth. The true value is here, and then it gets greedy, and it goes way over its value. And then people sell, and it goes way the other direction, at a discount, and it just swings back and forth. My advice is, again, to just avoid the products that Wall Street's trying to sell you, and look at earning profits. Profits they have a long-term impact, right? Day to day, that emotion in the market is what's driving it. From day to day, minute to minute, even week to week, it's emotion. It's whatever the buzzword is, whatever is being said on CNBC or some tweet from the White House. But what over the long term, what really makes stocks go up is profits. Profitable companies have appreciating prices, right? It's as simple as that. I say it's as simple as that because that's not what everybody looks at. Everybody focuses on the here and now, and they get all caught up in the fear and greed part of it. But what makes it more complicated is that with profits, they're negated by price. So think about an auction, right? I can tell you that this watch is worth a certain amount of money, and then I start going through being like an auctioneer, and I bid up the price, and this watch is probably a great deal at $100, but at $1,000, it's not. Right? It's no longer a good deal. The watch is still the watch. It still has the same function to it. It still has value. It's just not a $1,000 watch. And that's what you have to be careful with the stock. You may love this stock. And again, stock, it's the same with real estate. And you may have an emotional attachment to something. You may love it. Don't get caught up in the auctioneering of it. It has a certain value. When it exceeds that value, maybe you should think about selling it. You should certainly not buy it at that price. As far as profits being long-term, you would think that we would just have this in our psyche. And again, this applies to anything. It applies to Bitcoin. Bitcoin, if you believe in Bitcoin and you see value in it, regardless of what the price is today, you buy it, you hold on to it for the long term because you think there's going to be long-term profits to it, right? Same way with stocks. And that's built into behavioral economics where we talk about that in theory. Hey, if you just buy good quality things, they go up in price. But that doesn't happen. And Joe, why don't we have behavioral theory here?
I don't know.
Okay. Brian,
We didn't practice that one.
Help Joe out. Help Joe out, Brian. Why don't we? Why doesn't things work like they do in theory? People are stupid and crazy. People are stupid. People are stupid and crazy.
I see where you're going before or after it was well played.
We rehearsed this.
Okay.
People are stupid and crazy, right? And again, that's what makes the markets move on a daily basis. If you just did rational things, it would work out over the long term. Most people don't do them though, because they get wrapped up in the fear and the greed. So, as far as seeking profits, I got a tip for you, and this is about one of the best ones I can think of here in the near term. Whenever you're looking at a profitable company, you may say, hey, everybody's already bought that $100 watch is now bid up to $1,000. I'm not going to buy it, right? So what do? You look up and down the supply chain. You don't just focus maybe on that one that's too expensive, because there's probably other opportunities somewhere else, especially something that's not being hyped and promoted, right? So who's heard of Google? Everybody, right? It's owned by a company called Alphabet. A lot of us forget that, but Google is owned by Alphabet. Their stock is doing pretty well right now. Who's heard of Ciena? A couple people, one or two. How about, I can't even say it, Lumentum? No, they are in fiber optics. So Google is, over the last 12 months, Google is probably up more than that as of today, but when I did this a day or two ago, they were up 126% in the last 12 months. Google, I mean, think about how huge that company is, and yet if you'd have bought the stock about a year ago, you'd be up 126%. The interesting thing about that, remember the magician's hand, about a year ago, if you remember, Google was about the most hated of the Mag 7. Everybody hated it. Google was dumb. They missed AI. They let ChatGPT get ahead of them. Blah blah blah. Everybody hated Google. They're going to lose their search engine premium. Well, everybody hated them a year ago, and yet over the last 12 months, they're up 126%. But Ciena is a supplier to Google as well, not only to Google, but the other Mag 7 players. So even if Google had a bad year, because Ciena sells fiber optic equipment to everybody from Microsoft and Facebook to even the telecommunication companies like AT&T or Verizon. So they got this wide swath of clients and customers they can sell to. Ciena, which most of us have never heard of, was up 780, and Lumentum up 1,600% in 12 months. Crazy, right? These are all in the supply chain. So when you're looking at these things, don't just look at the big headlines that you're hearing about. Look up and down the supply chain, because if Google's doing really well, that must mean whoever they buy from is probably doing well too, right? Consequently, it also means whoever Google sells to is probably doing well. So you want to look both directions. It took me a long time to learn that, right? It wasn't easy, right? It's again, so simple, but you don't always think that way. Now, as far as profits, my caution is that you have to be really careful about earnings forecasts, because everybody lies, and CEOs especially lie, right? When a CEO is talking about profits, the old thing, if his lips are moving, he's lying, right? Because if he's telling you, oh, things are improving, that means they're horrible and they're going to get worse, right? And if he tells you, yeah, we're doing well, things are okay, he's probably sandbagging, and they're going to blow out their numbers, right? You can never trust them. And Elon, except for Elon Musk, who's telling you, right, it's always going to the moon. It's with him. So this is why we always, whenever there's earnings season, every 3 months they come out with earnings, there is always a surprise. Always. It's surprise to the upside, surprise. Analysts, surprise to the downside. It's like, what do these guys do all day? They study this stuff and they never get it right. And you always see too with earnings, they always beat earnings by at least 70-some%, right? Whenever corporations are consistently beating earnings by 78%, like I'm talking like forever, 50 years, you know that the earnings are all fake. Because how could you consistently be that wrong for 50 years, right? Because they want to be. So everybody lies. I have a picture up here of the outgoing Fed chair, Jerome Powell. Everybody lies, okay? Now, I'm going to stick up for him a minute here. I think of all the liars, he's probably the most honest. And and
He's
an
honest liar.
he's an honest liar. But the thing about him, think about his situation. Even if he wanted to tell the truth, right? And he knows that he knows in 3 months, this is going to be the worst recession we've ever seen in the history of the world. Is he going to come out on TV and tell you that? No, because it would just be a self-fulfilling prophecy and it would make it happen. So even if he wanted to tell the truth, not that he does, but even if he wanted to, he couldn't. So you really can't believe any of this stuff. And so as a lie detector, one thing I look at is price and volume action and the anomalies with it. I had that chart before where you can see the price going up and down, and then below it was the volume, how many people are buying or selling. I'm not going to dwell on that today, and I'm around all weekend, so I'll be happy to answer any questions offline. But the point about that is look for that. That's really one of the true lie detectors that you have, because what it's showing is that before the lies come out or the lies are told or the news is released, before that's happening, somebody in the market's making decisions, right? And if it's just complacent, it doesn't matter. But if suddenly there's a lot of activity where someone's selling or a lot of activity where someone's buying, then someone knows something that we all don't, right? And it's probably, an aide in the White House or someone, or, Nancy Pelosi's barber.
I just wish he'd go back to his tree.
The bottom line, though, is that profits are an end game. And, again, investing's for the long term. If you think out, if you ignore the day-to-day stuff, with my clients are like, I don't have to fire my clients. I'm blessed. My clients are the most fantastic people in the world because I've screened them out, right? I've not taken on the wrong clients, and I've gotten better over the years of figuring out who are the right clients. But the beautiful thing about my clients are that they don't panic, right? During this whole World War III that we're in, with bombing of Iran and Straits of Hormuz closed and all this stuff, like my clients just don't even care. They don't worry about it. They don't call me and say sell everything, or they don't say buy everything because it's an opportunity. They just go with it, because they know that long term we're trying to make profits. They're not getting stressed day to day. I tell them, don't look at your account every day. In fact, my brother passed away last year, but my brother was my worst client. He was only my client because he was my brother. Because he looked at his balance every day, right? He wanted to know, why did this go up? Why did this go down? And I literally used to just take a snapshot when he was at a high, and I'd text it to him, and I'd say, look at this until I tell you to look at it again. So over the long term, though, if you're invested in these good quality companies, they're going to go up. Now, good companies, again, you agree with them. I've got a chart up here of McDonald's. Who thinks McDonald's has the best hamburgers in the world? No one, right? No one believes that. But you know what? McDonald's is one of the pretty much consistent long-term profit makers for, 80 years, whatever it is, 70 years. You don't have to agree with the product to invest in it. And with a company like McDonald's, again, you can try and time the market, and you can try and consistently buy at every dip, right? But you know what? It doesn't matter. Even if you bought at the highs, the old previous highs, you're still making money today, right? Because McDonald's is a quality company, and actually more so than selling hamburgers, what do? They own real estate, right? So really, if people come to me and say, hey, I want to buy a real estate REIT, I said, have you ever heard of McDonald's, right?
How long's the timeline on
that? This one's only over the last 2 years. But if you stretch it out over 10 or 20, it's about the same, right? It's going to go up and down. I'd encourage you, in addition to looking for those anomalies in the price volume action, watch for entry points, right? Again, if you can buy this $100 watch for $100, that's a good deal, right? You don't want to pay $1,000 for it. If you can buy it at $70 or $80 or $60, it's an even better deal, right? When does that go on sale, or when the stocks go on sale? We know that when they drop down below certain points. Is McDonald's ever going to go out of business? Maybe, right? I don't know. Somebody could eat something there and get, some little kid could get E. coli or something.
Buys at every bottom.
And die. But yeah, that's the point about the magician, right? Because I can guarantee you, when this was happening, all kinds of analysts were telling you, sell, it's horrible. It's a tornado coming, run for the shelters, right? And then when they got it down, and so this is a weekly chart we're looking at. This is 200 weeks, so that's roughly 4 years, right? You hit down to a 4-year moving average. Everybody that was telling you to sell it just bought it, right? And they ride it back up. And it's like clockwork. And you can see these different points, right? This is not accidents when it hits those certain lines. It's because algorithms are programmed to go in at those levels. People get all wrapped up into Fibonacci numbers and Elliott waves. And what is all that? It's just products people are selling you, right? It's just BS. There's certain things that happen. It's not because it's mythical or because there's a certain wave coming on. It's simply algorithms are programmed to buy at a certain level, and they can only talk things down for so long, and then they get in and buy it. And again, the point is, you could have bought it at every high and still make money, right? So just buy in the middle somewhere. You can make plenty of money. I've done it over 40 years. I made a lot of money in the middle. I've never bought at the top or the bottom. Never bought at the bottom. The reason that emotional fear and greed kicks in every day, day in and day out, is because of conformity. And again, it's genetically, it's built into us. We're designed to pay more attention to pain and fear than we are to pleasure and happiness, right? It's the same way with conformity. We're designed to have that herd mentality to look around us. And if I look around everybody and say, oh, everybody's running that way, I should probably run that way too, right? Because there's a tiger or something chasing us. We have that tribal mentality. And that's not a bad thing. But in the world of investing, you want to be cautious because remember, it's happening not because the tiger's chasing us. It's happening because Wall Street is constructing a narrative, right? So the magician's doing something over here. We want to be watching their left hand. We want to be aware of what everybody else is doing, but we probably want to do something different. Not too different, though. Okay, and again, this is a lesson I've learned a lot. It took me a lot of years to figure this out. You don't want to be too different, because if you're too contrarian, then you miss all the opportunities. This is beyond meat, and this might as well be Dogecoin I put up before, right? It's a totally worthless company. I showed you McDonald's, right? No one wanted to buy McDonald's, just gradually goes up. Everybody wanted to buy Beyond Meat, a few years ago. They had no profits, no sales, no nothing. And eventually, long-term profits panned out. The stock went down because they literally had nothing. This is $1, right? This is like $55. So you can see the spread.
When they moved it from the refrigerator case to the freezer.
Yeah.
Because no one was buying it.
Exactly. That was your clue.
That was the clue. No one was buying it when it went in the freezer.
It has sorry to interrupt, it has 84 ingredients in it.
That none of us can pronounce. Yeah.
This slide makes me so happy.
Because you didn't buy it.
It didn't run out at the grocery store.
Well, it shows you the long term, good quality things do win out, right? Good eventually wins out over evil. But look at this too. This particular thing is back again to the weekly chart I'm showing here. So this is a 50-week moving average, roughly a year, right? 50 weeks, 52 weeks in a year. So every time it gets to that 50-week average, it can't get above it. Just can't get it. Somebody here, who knows what? Somebody pumped it up for a day. But it's really something I would have never invested in. But again, on the other side of it, there was a lot of money to be made here in the early stages of it. I personally, again, too much for my risk tolerance. That was going to be my point though, because way over. A client called me up and said, let's short it. And I actually thought it was a good idea. I looked in and I didn't do it because, I thought this would have been out of business 4 years ago. They are still making money, are still in business today. They're still selling stock. Not making money. They're still, the people that pump the stock are still in business. So when I say, be different, be a contrarian, but there's a famous quote from, it's attributed to Keynes, and we don't really know if he really said it because, the internet says he did, but we're not sure. But Keynes supposedly said, and this is Keynes from Keynesian Economics. He was a famous economist. He said, markets can remain irrational longer than you can remain solvent, right? And I've seen that time and time again. Something you think that's going up is eventually going to fail. Maybe it doesn't. Or you think something's totally going out of business and it just lingers on. Leos.
That's the 50-day moving average. What's the other orange line behind that?
This one?
Yeah.
That's the 200. So that would be the 4-year moving average. The opposite where we saw where McDonald's, and that's kind of the key. Whenever something hits a 4-year moving average, we're in a major recession, okay? And when McDonald's would hit that, people would figure it's not going any lower, and they'd buy it and it would bounce. During late 2022 throughout 2023, most of the indices other than like the Mag 7 were at or below their 4-year moving average, the 200 week. And I was very concerned and paranoid during that period, only because of the chart, because they were just so consistently low. Because normally that bounce, you're talking 2008, you're talking .com bubble. Below that line, it's like hazard, right?
Just pump $4 trillion of fake money into the market. People buy stuff.
It helps. I don't hate money. Okay, back to jiu-jitsu. I have arthritis. Watch this. I've been practicing my arthritis stretching. I'm like an owl. Look at that. I'm like an owl. So here's my jiu-jitsu. Fear, greed, complacency. When everybody's fearful, it's a time for you to be buying, right? And not wholesale to go out and do it willy-nilly, but think about it. If everybody else is panicked, it's unlikely the world's going to come to an end, right? Unlikely. If it does, it won't matter whether you bought stocks or not, right? So it's a good time to usually invest when everybody's fearful. But again, buy good quality companies that have long-term profitability. Don't go buy junk just because it's down 90%. Bounce down to their 1-year, 4-year moving average, 2-year moving average, buy them and ride them back up. Greed, during periods of greed, everyone's enthusiastic, everyone's buying. It's probably a good time to sell. Maybe you don't want to sell everything though. Jack doesn't ever want to sell his Bitcoin, right? So when Bitcoin's at an all-time high, he didn't need to sell it because he loves Bitcoin. He's going to hold it, right? I've owned ExxonMobil for I don't know how many years, long time. It was recently at a high because of all the Iran stuff. I didn't sell it. I just, it's going to go up. It's going to go down. It pays a dividend. It's a good company. I'm going to hold on to it. But what I would look at, again, kind of counterintuitively, during periods of greed, that's when I look to dump my weak stuff, right? Because during any market movement, more than 70% of stocks are doing that, right? So if you're in a period of greed, more than 70% of stocks are going down, or actually, if you're in a period of fear, everything's going down. So more than 70% of stocks are going down. So even the good ones are going down, right? That's when you want to buy the good ones. During periods of greed, even the crappy ones go up, right? So that's when hey, I've been wanting to get rid of this one anyways. I'm going to get rid of it at a top when everybody's happy. So look at those things. And in terms of complacency, again, this is the passive investing, the people that every week or every month or something are buying into their 401k. That's kind of the day-to-day thing. That's just where you buy the index, right? You buy the S&P 500, you buy whatever you think most people are just putting their money into. And when I look at stocks, I start with the S&P 500. I look at about 900 stocks total, but I always look at the S&P 500 because I know day in, day out, week in, week out, people are taking their 401k money and they're buying at least a portion of some of those stocks in the S&P 500. I also have S&P 500-ish. We'll talk about that in a minute. I would ask Joe, but he's already asleep. So you guys are all experts now. We're going to practice. Let's see if you can identify that. This is a current market condition. Actually, the market's up. We're in World War III right now, right? I don't know if you guys know it. We are in World War III. S&P 500 just closed at a record high in about 2 hours ago. So this chart is out of date because it's a day or two old. We're actually at a record high. What kind of condition are we in? What would you say we're in right now? Greed. We're in greed, right? About 3 weeks ago, a couple weeks ago, what were we in? Fear, right? Do you want to buy today? Probably not, right? Was that a good time to buy? Right? Unless we're a member of Congress or in the White House, we didn't know that it was going to be the low. Or they all knew it was going to be the low that day. We didn't know. So we could have bought here, we could have bought here, we could have bought over there. Didn't really matter, right? When you see this big, crazy jump up, that's called a gap, then you need to start backing off and saying, well, maybe I shouldn't buy. But even then, right? We went from we went from here to there in a pretty quick order time. So if you're buying for the day or the week, it's hard to time. But if you're buying in here and you're going to hold for the next 3 years, it doesn't matter. You're probably getting that watch at a good price.
Do you buy spiders a lot, or do you tend to do individual stocks more?
I'm an individual stock guy now. 10 years ago, I would have told you I was more indexes or ETFs, because back then you were getting charged transaction fees on stocks. All the discount brokers now it's virtually free to trade stocks. So why buy an index when you can make your own, right? I figure if the S&P 500 has these 500 great companies, I'm going to try and pick 100 of the better 500, right? What was happening here? Was this fear, greed? What was this? Complacency, right? And complacency, it could have gone up or it could have gone down. I can guarantee, and I can't predict the future. Whenever I see complacency, I know one of two things are going to happen. It's going to go up or down, right? It never stays the same. It never stays the same, right? This is why you should pay me to manage your money. I'm smart. When you have that, though, it's always going to do something. It's going to go up or down. It never stays complacent for long. But overall, we are in a long-term trend. And I know, again, we're in World War III, orange tariff, tax man, bombing guys in the office. But we are still, the market is continuing to go up. And you know what? Fast backward 4 years ago, Senile Joe was in office. It still went up, right? It still went up. So even though we're in the market going up and we're in a period of fear right now, hitting all-time record highs, doesn't mean that there aren't opportunities, right? There could still be things to buy. I'm looking at a particular sector that I've been buying into. I've been doubling down on it. And this is kind of the magicians are telling you, hey, it is all greedy up here. Let's do that. But what is going on over here? What is really low prices that's on sale that maybe isn't as bad as they made out to be? And right now, to me, that's the software sector. This is IGV, which is an index that follows that sector. Again, I don't buy specific indexes, but I buy these kind of stocks down below. And I don't know, again, because I can't predict the future, but this is the SaaS, or software as a service apocalypse, right? AI is going to kill everything. AI is it's going to eat all the software. No one's ever going to use TurboTax again. No one's ever going to use Adobe software, right? It's all over. They're all going to die. I don't know, right? We had hit a big bottom there, but now we're kind of in that complacency, right? I mean, it is sketchy and it's moving up and down, but sort of looks like maybe everybody that sold was going to sell. Maybe we hit a bottom. Again, I don't know. I have doubled down on these kind of stocks. I find it hard to believe that they're all going out of business. And this gets back to what do I buy? And since there's no transaction fees on stocks, I don't just buy Salesforce. I don't just buy Intuit or Adobe. I buy them all, right? I can buy 10 of them, 25 of them. There's a bunch in that sector. If I buy 25 of them and 5 of them go bankrupt, but the other ones all survive, over time I still make out, right? It's more important that way. The only thing I would caution you, don't go out and do this strategy right now, though, because I just read today, and I added this when we were sitting up at the campfire lunch. I just added the picture of, anybody know who that is? Joe, you knew who that is?
I know exactly who that is.
Joe?
It's the big short guy.
Michael Burry. Joe knew. That was not rehearsed. Because I just plugged that in before lunch, or during lunch. I just read that Michael Burry is recommending this trade. And I really try and do the opposite of what he does. So
He was right once.
that's right. And that's
Right? No, he was. He was right. And everything since then, he's been wrong.
pretty much wrong about. And that's the thing, again, right? Wall Street's selling you a product. They're going to pick someone that was right at one point, and they're going to put him on TV and talk about him. Yeah. Kramer was never even right once, though.
No.
So he's in this trade now, and that's really, now I'm starting to think to myself, maybe I made the wrong choice. We'll find out.
He's due for one.
One other thing, and I'll have Joe maybe say this. What were his? Okay, so this guy, people know who he is, Michael Burry. You see him on TV all the time if you watch that stuff, CNBC and stuff. A year ago, when everybody that's in the business has to file paperwork where you can look up and see what their assets under management are. A year ago, what was his assets under management like February of 2025?
I think it's 130.
About $130, $150 million. Okay? I'll just tell you, there's someone in this room today that's near that number, and you don't ever see him on TV. Okay, just put that in perspective, right? This guy is all over TV, and he's only managing 130 million. Okay, he's really managing nothing.
We closed it down, didn't we?
And he's closed it down since then too, because he was wrong so bad last year. He kept calling for a crash last year.
I'm just curious, when you talk about looking at these stocks, what are your thoughts about going through a process like better investing, stock studies kind of thing? I mean, there's a lot of different ways to analyze what a stock's done if there's a history on it, and then make your choices that way, other than this daily kind of.
Right, and that comes to the profitability, right? You're looking at good, solid, fundamental, profitable companies.
Yeah.
Did they make money a year ago? Did they make money 5 years ago? Are they likely to make money next year?
Is that part of your practice, or?
I start with fundamentals. I start with saying, again, I look at the S&P 500. The beautiful part of the S&P 500 is that somebody's already done a lot of that work for you. Not always, but for the most part, to be in the S&P 500, you got to be a profitable, pretty much sound company, right? Or you wouldn't be in there. And the reason the dollar cost averaging in the S&P 500 has worked for all these years, or even being in the market long term, it's just the fact that they throw out the bad companies and they bring in good ones, right? So every month or every quarter, the S&P 500 is never static, right? You go back 50 years ago, you have maybe 20 of the companies today that are in the S&P 500 were in there, 50 years ago. So they're putting in new companies all the time. That's the magic. You're always looking for what's going to be, not only who was profitable yesterday, but who's likely to be profitable tomorrow. We can talk offline because I'll go down to Joe's keeping me from digressing. So I'll go down a rabbit path, and you'll never get me out of here today. But we can talk about that later. But you're focusing on good quality companies, and you're not trying to just beat the market tomorrow. But you're also,
I mean, that's day trading. Right?
That's day trading, right? Or even swing trading. But the part of it is you're also not trading, right? You're also not just buying forever and holding it, right? In 2008, I got out of the market. And I ended up losing 18% or something back then. Well, I was sad at the time until I found out the market went down another 50, right? So you don't want to sit through every market. I pulled out of the market at the end of 2022, early 2023. Again, I talked about that the market was consistently below that 4-year moving average. I was concerned. I wasn't fearful. I wasn't like that condition. I had a rational reason for being concerned. I was wrong, right? It turned out I was wrong because the market recovered. It did not drop. But there are reasons to get out of the market. So this gets back to your question too about the S&P 500. April, you asked that. So I talked before about you want to invest in the S&P 500-ish, right? Again, conditions are always changing. 5 years ago, I would have told you, listen, if you have $1,000 of life savings and $1,000 life saving, if you have that and you want to invest in the market, just buy the S&P 500. It's going to consistently go up. It's got good companies in it, blah, blah, blah. That's changed over the last, 6 years or so because the S&P 500 is so dominated by like a dozen companies. Here, the Mag 7, and there's a little bit more than that. So it's about 10 or a dozen companies, but they make up 40% of the profits of the S&P 500. So the S&P 500 is no longer that, it's just no longer that stable kind of long-term growth thing. It's so heavily weighted to these high big tech companies, which as long as they're doing great, that goes up. But in 2022, when those guys all fell apart after the pandemic, the S&P came down hard. So I'm now advising people, rather than just investing in the S&P 500, look for equal weight. And so RSP is one of the indexes that does that. You pay a little bit more for it in terms of the management fees, but I think it's worth it because RSP, and again, there's others than just this one, but rather than just investing by market cap and having all your money concentrated in the big companies in the S&P 500, it puts you in all 500 companies equally. Okay, now, again, when the big guys do really good, you're not going to do as well. But when those guys don't do so well, you also don't do as bad. So you do get more stability this way. And again, this is 20, almost 20 years right here. It's stable. Of course, it's going to fall apart when there's pandemics and stuff like that, just like anything else does. But look how short-lived they are, right? I mean, this thing in 2015 or whatever, there was like a 2-day panic. We've never, and really since in this whole 20-ish year period, very few times did it ever break this line. And this line happens to be, we're looking at a monthly chart. So that's 50 months. What's that? We're back to 6 years or something, 50 months. So if your time horizon, I say like 3 to 5 years, but this chart will show you pretty much if your time horizon is 6 years, you're pretty much never really going to have a major catastrophic loss, right? You're going to be able to pull through it. Yeah, that's if you never sold it. It's buy and hold. You're still only going to hit that 6-year line and bounce off of it. And again, these are excellent buying opportunities, right? If you can catch it before it breaks the 4-year moving average and buy it before it bounces off the 6, that's like the perfect time in the world to buy. There's just very few of those opportunities. But the equal weights, I think, are a great way to get long-term solid profits. And nobody tells you to buy that. That's the other thing, is there's no magician saying buy equal weight. But it's a great thing that you should be looking at. As far as niche opportunities, and I really like niche opportunities, like I told you, look up and down the supply chain. Right now, there's a company called Huntington Ingalls. Anybody ever heard of them? Huntington Ingalls? You've never heard of them. This is probably a great company to buy. Guess what they do? They make the ships for the Navy. Submarines, aircraft carriers, right? We're not going to export this to China, right? Because we've already hollowed out our manufacturing enough. So I think any of the downs that these guys have are over. You can see now that we got into a Cold War, what I consider now as a Cold War, it's gone up. It's fluctuated here for the past few years, but it's really escalated. Even before we started bombing Iran, which again, someone probably knew we were going to do that before we did, like no surprise. You can see the volume, how much the volume was really going up as the price was going up, well ahead of even before we bombed Iran last year. So I think as a good company, I think that the Navy is integral to where we're headed with the Cold War that we're in. And I think that when Russia invaded Ukraine, that showed Europe the need that they have for NATO. And I think what we're doing in the Persian Gulf right now is showing the world how much they need the U.S. Navy. Okay? It's a little my political commentary, but I think this is a very good long-term stock. And again, look up and down the supply chain. Who are they selling to? Well, we know they're selling to the government. Who are they buying from? Is where I would look up to narrow that. Okay, couple predictions. Tactical's not here. He bought me a crystal ball, so I can't ever say I don't have a crystal ball anymore. Don't bet against the U.S. And I got to say that to our community, because a lot of times we get really down on the U.S., right? We can think of all the horrible things that our country does and what it's become and blah, blah, blah. I've been all around the world. I still live here. Like, I have no plans of moving. I know a lot of people want to go to other places. The U.S. is the best place in the world, right? It's a best house in a bad neighborhood. And that's true from a stock market standpoint. We dominate in the 5 areas that matter the most: technology, energy, agriculture, the finance of putting all that together, and then finally weapon systems. No other country can do those 5 things as well as we do it. And you're probably saying, oh, John, you just like orange tariff tax bombing man, and that's why you're saying this. I did a video, dates up here, March 5th of 2022, so that's when old Senile Joe was in. I did a video, it's called Global Choke Points. I hit those same points in that like 30-second video that I put up 4 years ago. It doesn't matter who's in the office, okay? It literally doesn't matter. And is Matt in here? Matt's not here. Okay, whenever you guys see Matt, we got to tell him, I put this slide in just for him. Anybody know this meme? Yeah. No matter who you vote for, who do you get? You know what? I don't hate money. And politically, I might not like that, but I don't hate money. And I know that. Whether we get Obama or Bush or Trump 1 or 2, right, or Biden, we always get McCain. We're always going to be fighting wars somewhere. And so I invest with the deep state. I just,
Solid call.
I don't hate money. That shift I talked about before, we're in a generational shift. There's some people talking about it, but I don't think enough people, and probably I'm glad enough people aren't talking about it yet. We're in a Cold War II. I think it's an economic war. I think it's the same but different than the last Cold War, right? Totally different. This one's economic. The last one was more about military and nuclear weapons and things. I'm not so much worried about China invading Taiwan and all that kinetic stuff. I think this is an economic war. And just like then when we had mutually assured destruction through nuclear weapons, I think we're now in a mutually assured destruction through economic means.
China is down huge from January. They were up like 22%. They're down to like just 2%.
China's been.
We're choking them out of oil.
If I put a long-term chart up here of the Chinese S&P 500 for the last 20 years, well, they've gone from taking basically almost 38% of global production. The chart's down. They have not. China destroys. It's not China. Communism destroys wealth. Period. They don't make it for themselves, and they steal it from others. Jake.
What's your take on Ray Dalio and the changing of the guard and how empires rise and fall? And he's saying that we're going down and China's coming up.
He's talking his book. He's got a lot of investments in China. I don't like Ray Dalio.
Okay.
I think he's
Follow the
I
money.
think he's talking his book. He's the guy that's hollowed out our country and did all that investing in the last 30 years in China. I don't see it that way, right? I really think, and again, it's not patriotism. It's just I just look at the facts. There's no country. The song "God Bless America." It's God blessed America. The geography is just so amazing. I remember every president since Lyndon Johnson, right? As incompetent as they've all been, right? We're still here. We're still on top. And I can remember in 1990 when we thought the Chinese were going to take over and buy Rockefeller Center, and right, they went into a 35-year recession. And just not even 6 years ago, Germany was ascending, man. They were getting all this cheap oil from Russia. They're the dominant power in Europe. They're all the precision equipment and machinery, and the third largest economy in the world. But right, they're going into the next 30-year recession over there because of oil prices, which I think we've manipulated. Again, I don't invest against the deep state. I'm running out of time, so I'll hit this real quick. And again, I'm going to be around all weekend. I think we're on a generational shift, though. The peace dividend that happened around 1990, 91, if you remember that, when the Soviet Union collapsed, they talk about the peace dividend. We could hammer our swords into plowshares and we didn't have to invest in defense anymore and blah, blah, blah. We're going to sing Kumbaya. Those days are over. We're 30, 40 years into this. We've made China a formidable enemy, and the powers that be know that they have to do something to stop that. And we're going to. For 80 years, the U.S. sacrificed their economy for peace. We gave everybody a chunk of coming out of World War II, we were the factory of the world, right? We were the China because we blew everybody else was blown up. And so everybody was buying everything from us. We, at that time, had something like, 90% of the known gold reserves in the world were in the United States in 1946. We had all the gold, we had all the manufacturing. We spent that gold and that access to our economy over the next 80 years to maintain world peace. You're going to argue how good or bad we did of a job of that, but that's what they did. That game is up. And we're now in that next period, right? I don't know if it lasts 30 years or 50 years or 80 years, but we are living through a major, major geopolitical shift. And it's now about, globalism isn't dead. Okay, don't believe that, but it has peaked. We're never going back to the pre-COVID days of total globalization. There's going to be more stuff made in America. I wrote a book on this almost 10 years ago about the robots are coming, and it wasn't so much about automation taking everybody's job. It was about that factories are coming back to America. Factories mostly run by robots, okay? And that's not changing. Automation is being replaced, is replacing labor, just like digitization replaced the print and analog media. If you remember back in the days, there used to be phone books and magazines and all these printed things, right? I spent some of my career in the paper industry, right? It doesn't exist anymore. There was literally billion-dollar industries that are just totally gone, not because anybody put them out of business, but just things got digitized, right? It's much cheaper to publish a a PDF than it is to mail a letter. Kodak, all those guys. So, and that's going to continue with labor, right? The sort of good news is that we have declining demographics. So it's actually coming at not such a bad time because we don't have the workers. The bad side of that declining demographics, though, is that most of these 80 years when we've seen this major economic growth, it's because there were more people being born. It's not because we did better things. It was just because more people needed stuff. Well, now we're plateauing. There's not going to be natural organic growth anymore. So we're going to have to replace that with something else. I do think the U.S. will do it with productivity. One final thought I'll leave you on with this stuff is that if you remember your history, there was something called the Great Leap Forward, late 1950s, early 1960s. I think China's been going through that for the last 10 years or so. They called it, Made in China 2025, all these different things about, China's big investments in green energy and stuff and batteries and all this. They're trying to go through this new Great Leap Forward. They don't dare call it that because if you remember your history, they killed probably about 40 million people in like 3 years time span. I think we're going to see more people than that die in China in the future because China is installing the world's largest robotic workforce, and they have 1 billion people in poverty. So they're not even trying to create jobs anymore. They used to supposedly, they had a social contract that do things that even if they didn't make money just to keep people employed. Well, they are putting in far more robots than anybody in the world. And they've got, again, literally 1 billion people that are in poverty that have no chance of progressing or earning a living anymore if they're replaced by robots. So that's, I think it's bad news for China. In any case, I don't know if we have time, but if we have questions, Nicole, do we have time for anything? Or are we done?
You literally just went up to your last minute, so we probably could do one question.
One question. Anybody but Joe can ask a question. And Joe and Jake cannot answer questions. In fact, if Jake has a question, Joe has to answer it.
That's a great idea.
You were talking about getting into the S&P before. You threw out the hypothetical of getting out in 3 years. Why would you get out in 3 years? What kind of things might trigger you selling out of that position at that point?
I don't know. Did I say that?
Something like that.
I'm constantly looking at moving in and out because I don't believe in just staying in forever. And I don't know. I don't know who's going to win the midterms. I don't know who's going to be the next president. I know it's going to be John McCain, right? But there's transitions, and I just I'm 100% in the market right now. I mean, I'm full bore in. I don't have any plans to sell, but I'm ready to. There's nothing that says I wouldn't go to 30% cash at the right point and reassess. You never lose money taking profits.
Now, where do we find the PUG ETF where it's following all of your trades like they do some of these other?
Wealthsteading Podcast, investmentwealth.com. I have my blog post out there. If I buy or sell something of substance, if I'm just doing a little balance, I don't talk about it. But if I'm actually buying or selling something, I put it there. It's free. You don't have to pay for it. You can read about it. You do it yourself. I don't care.
We'll get AI on analyzing that tonight.
Get AI. AI says very nice things about me. I like Gemini. I ask them about myself all the time when I need a boost, and they tell me how great I am.
If anyone's really interested in investing in AI, I said this a couple years ago, but Google is the sleeper. Like everyone's shitting on Google. I'm telling you, their AI stuff is next level. They just don't have as good of a marketing team because they're already public.
Yeah, Google is.
The other two are going to public this year, so they're spending tons of money on word of mouth.
Google is one of my top positions, and they're in Waymo self-driving cars. Obviously, their search has not suffered at all in the last 3 years with all the AI. They certainly tap my credit card multiple times a month in all the services I use from them. They're not going anywhere. They know everything.
The paper that created ChatGPT is Google DeepMind.
Yeah,
They created the industry.
Google's a great company. Google, when you think about the Navy company I said that makes the naval ships, Google is more tied to the Pentagon than anybody else. So something else to think about.
Okay,
April.
So we're out of time. That doesn't mean you can't still ask John questions. I noticed there's another tea out here from Jenny, though. Did she talk about it?
Yeah.
She dropped it and ran. So if you want to try another tea from her new tea brand she launched, check it out. And If you want to pre-buy, there's a QR code there. Definitely tap into the Wealthsteading Podcast. Like, that's how I started learning just the basics of understanding investment. Do I understand it now? No, but I understand more.
Earn, save, invest.
Yeah.
Earn, save, invest.
So where we're going from here is we're starting the 10th anniversary celebration with our next session with Jack. So we're going to make ourselves some appetizers. He's going to talk about flavor pairings. That's up the stairs. It's actually easier to go outside and up the stairs than up these stairs. John, thank you very much. The other thing I wanted to mention is that there is rain coming at 6 o'clock probably.
Sweet.
So if you need to think about a campsite or something you left out, make adjustments. You have about an hour right now. And that also means barter blanket tonight. So barter blanket is tonight. Will still happen. We'll be under Taj Mahal and not out by the fire pit in the rain. If it doesn't rain, because it's Tennessee and things change on a dime, then we'll have it outside. But we'll do it like we did last year, where we bring the fire pit, the propane fire pit in, and we do it that way. So.